You know, we were talking earlier, I don't know if you heard Steve Leisman, Mike, the issue of effectively whether Jay Powell, he may be sticking the landing in certain ways, but maybe he's really not, because the truth is that if the markets love it, maybe inflation doesn't go away.
Well, that's a really good point. You know, I probably take a little bit of a different angle. I think the Fed yesterday actually reestablished some credibility. I mean, they said that, you know, no matter what happens, even if employment doesn't go to, you know, where they expect it to go, they're going to fight inflation first and foremost. And that removes, as you said earlier, a huge amount of uncertainty. You know, that's what the markets want. The markets know how to deal with a Fed that's tightening, with you know, liquidity that's going away. What they don't know how to deal with is higher inflation that runs away from the markets, and that's something we haven't had to deal with in a few decades. And so the market, I think, is telling us, both on the equity and the fixed income side, that actually just the opposite. The Fed has established or reestablished credibility that they're going to fight inflation, that they're going to tighten liquidity, and that removal of uncertainty should be good for stocks and should be good for credit, at least from the perspective that they can now trade on fundamentals, right? And that's the most important thing, is you want equities and you want fixed income to trade on fundamentals, not on some unknown of runaway inflation in the future.
Lisa, you believe the party's over? It's not over? Looks like the party's still on.
Well, Andrew, we're still positive on the equity market. And really the reason why is, if you look at the overall macro landscape, what you see is that most indicators continue to remain in solid territory. And then if you look at corporate earnings, we really have a nice case of continued rises and increases in the revisions and estimates for 2022. So with that, and again, to Mike's point, with some of that uncertainty around Fed policy removed yesterday, we continue to remain optimistic on the market. And obviously, we'll want to watch the incoming data, particularly on inflation, as we have all been talking about. But again, the base case is on the bullish side.
Mike, if you're as bullish as you are, what do you do about it? Meaning, if you're,
well,
if you're watching right now, go ahead.
I wouldn't necessarily say I'm incredibly bullish. I just said that I think now we can actually start trading on fundamentals. The fact of the matter is, actually, earnings probably are peaking right now in Q4 and are likely to start to slip in terms of earnings growth at the macro level next year. And so I wouldn't say that we're uber bullish. We still think there are cyclical areas of the equity market that continue to perform well, certainly in the first half of 2022. And on the rate side, you know, listen, I would say I'd probably tilt on the more bearish side, right? Knowing that the Fed, remember, goes back to that certainty I mentioned, knowing that the Fed is likely going to hike rates, knowing that the terminal rate is likely higher than what the market currently expects, we can, with some degree of certainty, if you take inflation, if you take what the future Fed funds rate, if you take the reduction of the balance sheet, or the ultimate reduction of the balance sheet, certainly relative to GDP, if you look at economic growth, which is probably going to be stronger than most expect, then rates are going higher too. And so I'm not necessarily incredibly bullish, but I am bullish on the fact that markets can now trade on fundamentals, whether that be rate markets or equity markets. And so we do see chop in 2022 as earning growth starts to decline. We do see higher rates. We see a higher 10-year. And, you know, we think the Fed has kind of set us up for that next year.
Shepard Smith here. Thanks for watching CNBC on YouTube.